Hi, I'm David Humphreys. This tutorial is a summary of most of the aspects involved in property investment. We will look at how you can guarantee a successful portfolio with my top 10 must-do items or golden rules, each of which is covered in great detail in the Property Investors Building Blocks. The first golden rule is to build a reliable and cost-effective power team. You need to identify and recruit these people before you start looking for a property to buy. You will find all the information and details on who makes up your power team and how to find the right people in set 5 of this course. 2 reasons for building your team before you start looking for a property. You will need a solicitor to handle the purchase of the property unless you are going down the DIY route. And the second, you really should have identified a reliable builder and have a clear idea of the cost of any refit or renovation work, unless again you're going to go down the DIY route. I would venture to suggest, however, that your time will be better spent as an investor than either as a solicitor, DIY builder, or any of the other trades and professions that you will need in your power team. The second golden rule is research. You need to thoroughly understand your investment location and the neighbourhoods within it, which will only happen if you do sufficient location and neighbourhood due diligence. Most really successful property investors know everything about the location and neighbourhoods that they are investing in, and only buy property that fits their strategy in the relevant neighbourhoods. Most successful investors invest in a number of neighbourhoods, but in one or maybe a few locations. You need to gain this knowledge before you buy your first property, and you must test both your research and your understanding of each neighbourhood with local residents and others who may be familiar with it. Go to the due diligence tutorials in set 4 to find out in detail how to go about this research. The third golden rule is to identify your customer, either your tenant or your buyer. Both buyers and tenants break down into a number of categories, and each category has its own and sometimes unique needs, wants, expectations and perceptions. And remember, perceptions, or to use another term, biases. I prefer to call both my buyers and my tenants my customers. A number of people still regard or perceive tenants to be second-class citizens, but in reality, if you are a buy-to-let investor, your tenant is definitely your customer. You hope to become wealthy from letting to them, and therefore you should always treat them well and with respect, so long as they remain good customers. We discuss who your customers are and where they're coming from and what they want and need in set 8, Customers. The fourth golden rule is to develop the quality product your customers deserve. You are a customer, and you doubtless demand quality from your suppliers, so why should your customers be any different? When you arrive at set 6, the tutorials on property opportunities, you will find that there is a wide variety of properties suitable for investment. In each case, you must make sure that your products, in this case your properties, are always the first choice of your prospective customer. It is only by making certain that your property is a quality property will you attract good customers, just as you are attracted to quality products. I also happen to believe that everybody, and this particularly applies to tenants, deserves decent quality housing. Both buyers and particularly tenants can be the unstable elements in a property investor's business, but quality puts you on the front foot. I hope to prove to you through this course that quality housing outperforms substandard housing, of which there is still far too much, particularly in the private rented sector. Golden rule number 5 is to set and maintain high standards in all aspects of your property business. Only then can you hope to grow wealthy and ensure that the people working with you in your power team will reflect these same high standards. This is vitally important if you are going to avoid or mitigate the inherent risks in property investment. These standards are covered in detail in set 11, Renovating for Profit, and set 12, Standards. The sixth golden rule is to think numbers, not properties. Whilst properties obviously feature in this course, numbers probably feature more often. In an ideal world, we should all be bankers and be able to invest in money, then we could buy money, sell it, and make more money on the transactions. However, one of the major features of property investment is leveraging, which you can't do when trading foreign currency or when buying and letting money in the form of a lease or hire purchase agreement, which is called lending, where again leveraging is denied you. So, as a property investor, you need to introduce a property into the equation and then a customer, but even then still think numbers. The seventh golden rule: operate at the highest level of loan to value, or LTV, that you are comfortable with or able to. I say comfortable with because the higher the level of LTV, the higher the risk involved, so your comfort level is very important. A good analogy is driving a car. Whilst there are risks in driving any car, the faster you drive a car, the greater the risk of having an accident, and generally high-speed accidents will hurt or damage you more, particularly if your car is not designed to be driven at high speed. The performance of a portfolio of properties, or even an individual property, with a loan-to-value of 75 or 80% is substantially better than with a 50 or 60% LTV when described as a return on your cash. But at the end of the day, you have got to sleep at night and not worry yourself into an early grave. Some investors that I know are completely debt-averse, but then they probably shouldn't invest in property at all. If you're not going to borrow, then there are much safer, less stressful, and probably easier ways of investing which will give you similar returns. It is the ability to borrow, that is, leverage your money, that sets property investment apart from most other investments. You'll find leveraging and its benefits explained in Set 1 Foundations. The eighth golden rule: keep your cash burn to a minimum for every property that you let. Your cash burn is the amount of cash that you tie up or leave in the property after your first tenancy starts. In simple terms, your cash burn includes the deposit, plus your acquisition and refit costs, and maybe the first month or two of mortgage payments. The problem with burning cash is that all of us have a finite amount of cash to invest. Once you have invested that cash, you are stopped from investing until market forces increase the value of your property so that you can use the increased value as security for further borrowings and start the whole process again, unless of course you run a fix-up and flip strategy in tandem with a buy-to-let strategy. If you are able to reduce the cash tied up in each let property, you can increase the size of your portfolio faster. If you can reduce the cash burn to zero, you can keep recycling your money and you will not be dependent on market-driven increases or fix and flip. How you reduce the cash tied up in your property to zero is explained in detail in Set 11, Renovating for Profit. Golden rule number 9 is plan for and utilize all the tax breaks available to you. I obviously mean legal tax avoidance rather than illegal tax evasion. It is quite possible to develop a portfolio of properties and legally enjoy positive tax-free rental income for life. And I'm not talking about living off borrowed money, which is yet another option. It is also possible to buy, renovate and sell properties over a period of time, converting the profit into a capital gain, which currently enjoys a lower rate of tax. Both are explained in Set 13, Taxes, Law and Regulations. Golden rule number 10 says, be prepared to adapt your strategy to changing market conditions. It is very easy to grow a portfolio in good times, but you must also be able to survive bad times, even if you are temporarily unable to continue growing your portfolio. You must assume that bad times will occur at least once, if not more often, during your life as a property investor. Equally, possible or potential changing market conditions in a location or neighbourhood need to be understood and planned for. This is covered in Set 1, Foundations. Last but not least, a bonus rule. Be prepared to work hard because the days of easy money are over. When property values were rising, almost on a daily basis, along with banks who were desperate to lend money to property investors, it was virtually impossible to lose money. In fact, it was also very, very difficult not to make a profit. Those days have gone, and I don't see them ever returning. Even if property values were to boom again, I don't believe that bank money, which helped fuel the last boom, will be so easily available to fuel the next. That said, I will demonstrate through this course that property investment remains the best deal in town, giving everybody, regardless of where they live in the world, the opportunity to develop and generate real wealth, almost regardless of where they invest, because the principal rules of property investment apply worldwide. That brings me to the end of my top 10 golden rules. I look forward to seeing you soon. This is David Humphreys signing off.